Hi, folks. We'll be kicking off in a minute or two at the 2 p.m. start. Rightio, let's get started. Welcome, everybody, to Anchor's Where Will the Money Be Made webinar, something we do every quarter to run through our asset allocation views, how we see the world, and where you think you should be invested from a macro perspective. Obviously, from an individual client perspective, very different approaches are taken depending on somebody's risk return outlook. But it's very important to have a macro look at the world and see what's happening. Seems like a crazy world at the moment, and we've got some of our experts out there to talk you through it. I'm going to be doing basically an introduction, but a lot, certainly a lot of interest. Obviously, at this time of year, people are back from holidays and wanting to catch up. But at the same time, there's some really crazy stuff going on out there. Presidents getting extracted from countries, Trump wanting to take over Greenland. And I think what we want to try and do is kind of hold your hand and walk you through the impact that this has on markets. Please feel free to put questions in the Q&A down at the bottom. We'll be having questions at the end of it. And yeah, over 1,500 people registered for this webinar. So a lot of interest, and I'll quickly run you through some initial slides. Today we've got Nolan Wapenaar, our Co-Chief Investment Officer, talking to us about fixed income. On the equity side, we've got Mike Gresty, who runs a lot of our local equity funds with Liam Hector, who's going to be talking about local equities. And then James Bennett, who's always very interesting to listen to on the power of I don't know. That sounds pretty intriguing, and intriguing indeed it is. Just a quick kind of update on where we are as a business. The Anchor Credo businesses, Anchor merged with Credo Offshore about 14, 15 months ago, and that's taken us to about 306 billion rand of assets that we've got in the business, 550 people across the globe, and looking after clients now in South Africa, London, Mauritius, and a recently launched Namibian business. The summary, kind of in very short format, that we want to run you through today is nobody's really backing away from the bull market. At this time of year, we get a lot of the big investment banks coming through with their news and perspectives for the year. And it was very difficult to find a negative report. And why is that? Most people, the world is no doubt revolutionizing. Technology is changing everything. And I think most people are of the view that no matter what valuations are, you have to have some chips on the table. Things do run another 20, 30%. You certainly want to be invested. So the market is very expensive, about as expensive as it's been in the last 20, 25 years. So that's not a comfortable place to be investing. Ideally, you want to be investing when things look pretty cheap and prospects are good. But not surprisingly, when things look pretty good, shares are fairly expensive. And one of the key slides we want to take through is, despite all the geopolitics and all the noise going on there around the world, the earnings outlook for particularly US companies looks extremely positive. And that's what's buoying up the market. But we also make the point that outside of equity risk, we can still earn good returns. Interest rates are at pretty high levels. So, we've got some funds delivering clients a very reliable kind of 7 to 10% without the equity market volatility. Just a comment at the bottom, just a snip that I took from a UBS note the other day, and this is what's coming through from their global economists. South Africa's got broad-based economic improvement in 26, 27, with lower CPI and better fiscal backdrop. So all of the events that are happening around the world are playing into the hands of the SA bond market, the SA government, but Liam will take you more through that. So this is the stage in which we operate. Pretty strong global GDP growth forecast for the next few years, above the 3% level. And on that stage, about 65% of equities are listed in the US market, and some very, very strong compound growth expected. On the right-hand side in the gray bar, and Mike Gresti, I think, uses the slide again, but it's worthwhile putting up twice. 15, 14, 11%, so kind of 35% growth forecast for the next few years. And if that does come to pass, irrespective of where valuations are now, you're still likely to get a pretty decent return. But you'll see from the equity side, to express our caution, we don't think you'll get all of that 15% in return. We think the market will derate a little bit. So we're looking for about 8% from global equities. So to sum up what we're going to tell you today, from a domestic point of view, there's positive momentum for South Africa. Bond yields are down. The rand is stronger. I think a good way to think about South Africa is we're an exporter of gold and an importer of oil. So that trade balance is pretty positive. And the very high commodity prices are resulting in big tax bills for the mining companies, feeding through into the treasury. And that becomes a very virtuous circle. As the treasury's got more money, it needs to issue less bonds to raise capital. And that in turn is a positive impact on the bond market. That makes our cost of capital cheaper. On the domestic equity front, so we think you can kind of get 9% from South African bonds over the next year, which is pretty close to the running yield. From a domestic equity perspective, 2025 was a standout year. The MSCI South Africa, which is very commodity heavy, it was up 74%, which is nothing short of insane and the biggest year ever. But it's very much commodity shares driving the market. Speak to the retailers and some local businesses out there. It doesn't seem as good as the market seems to suggest. So Naspers processed commodities and things that are not really SA driven. But there certainly is progress on structural reform. And we expect a pretty strong return again. We're saying 12% from the SA market. Moving globally, we're a little bit more guarded in terms of returns. So very strong earnings growth, but we think the market, just being conservative, isn't going to capture all of that return, and there will be some derating. But when things are pretty expensive, the price for being wrong is big. So there's every prospect of a 10 to 15% correction along the way. If the big expectations are not met. But we think the market will end higher this year and next year. Mike Gresti will tell you to keep a balanced perspective on 2026. Consider what could go right. As we said, the valuation's pretty high, but growth is strong and broadening, and there's some more Fed rate cuts to come. So, we asked the question, how well risk-proofed is your equity exposure? Because the risks are high. If for no other reason, then valuations are pretty expensive. From a global fixed income perspective, we're fairly neutral. Inflation is likely to fall faster than the market expects. Some more rate cuts to come from a global perspective. But we think bonds are fairly well priced. Typically when the market is in a bit of a panic, they took solace in the US dollar and US government bonds. And that's simply not happening at the moment because of the discomfort with Trump's actions in America. We think our global high yield fund is a good place to be, with bonds maturing in the shorter term. And that'll get you about 4.75% per annum in dollars. So this is put graphically on this asset allocation table. So you can see from a domestic perspective, favoring equities with still some pretty decent returns coming through from bonds and listed property. From a global perspective, less bullish on these asset classes. Equities fairly positive with about an 8% return, but not wildly bullish, and a little more negative on government bonds and corporate credit. Once again, we've been talking about alternatives for quite some time. We think these markets and the returns you're able to achieve from these instruments that aren't listed are a good place to be. We're delivering a 10 to 12% in our local alternatives fund. Our global alternatives fund, the conservative one, has done more than 10% in the last year and more than 12% for the more aggressive fund. So these are funds that don't have the same volatility as equity markets, but still getting equity-like returns. Just to make the point that our industry is very bad at setting price targets. So having a bit of a jab at ourselves. I just thought this graph was quite self-effacing and interesting. These are the average calls of market strategists every year over the course of the last 25 years. So you can see there's never been a year when the industry has forecast negative returns in aggregate, when the average comes at about 5%. So you take what guys say with a pinch of salt. Nobody wants to go and forecast a -20 or a +10. So surprises happen on both sides. But the industry is pretty positive at the moment. And then just two graphs that us fund managers pull out every now and then, just the historical context of the JSE All Share, and followed by the S&P, where the trend is upwards. And you're sitting with indexes that on average are going up between 8 and 10% per annum. So it's a big call to not be invested in them. I think one doesn't know when the next return's coming, but it's, we looking at risk very carefully on a stock specific basis. I think you want to be in the right shares, but this is the journey and what you want to ride over time. As always, there's some very interesting funds in our portfolio. One that's doing particularly nicely at the moment is the Credo Best Ideas portfolio. This is our offshore investment business, 32% return in dollars for 2025, which is very exciting. And you'll see both this and our local equity funds in Anchor are compounding since inception at about 11 and 11.5% per annum, which is obviously a very nice place to be. One of the other reasons we think you should remain invested in equities is there's certainly some secular trends in the world at the moment, which are going to be strong irrespective of economic conditions. And you simply, if you are an investor, you've got to be invested in the future. And things like artificial intelligence, autonomous vehicles, travel, obesity drugs, defense, US banks are trends that you can back quite confidently. Back in South Africa, the macro picture, the structural reform, allowing the private sector to invest in state assets like the ports, this is creating some very positive sentiment. But industrial South Africa is changing. Chery is now South Africa's #2 car seller. This is the unit sold in December 2025. Suzuki outside of South Africa is #3. So things changing on the ground. I see Chery's just taken over Nissan's plant in Gauteng. And again, in South Africa, you've got to be invested in the right segments of the market as this change takes place. South Africa's economic growth is not exciting, as you can see on the right-hand side, down to less than 1% in 2024, but some positive acceleration. These are not exciting levels. It's not like the 3% of the early 2010, 2011, like you see on this graph, but certainly a change in the right direction. And sadly, this is South Africa's average growth, as we came through the Zuma years, 2015 to 2024, averaging less than 1%. This is one of our local funds that's, fund managers get it right. They secure their style. They do the same thing year in, year out. There's some pretty good returns to be had irrespective of conditions. So this is our Anchor Stable Retail Hedge Fund. And this is really what every investor is looking for, or certainly should be looking for, is that kind of 12 to 15% year in, year out, which is exactly what this fund has achieved. You can see the chart on the left-hand side. And this is a fund that's now over 20 years old and achieving that nicely into double digits since inception. So that, folks, is the introduction. I'm now going to hand over to Nolan Wapenaar, our Head of Fixed Income and Co-Chief Investment Officer, who's going to tell us about the world of income.
Thank you very much, Pete. And hello, everybody. It is wonderful to be back. And thank you very much for joining us for Where the Money Will Be Made, the first one in 2026. I've turned my regular presentation a little bit upside down today. And that's because I typically end with the Rand views. But the number one question we've been asked of late is, what is happening to the Rand? Why is it so much stronger? and what are the prospects from here. So I figured that this time around, what we will do is actually start by talking about the rand and then build up our view by putting more and more detail onto the bones. This chart is probably familiar to everybody who's been attending these webinars, and it's Anchor's view on what the fair value of the rand is. It's based on the sort of economic view of purchasing power parity, which implies that the rand will depreciate against the dollar by the inflation differential in the USA versus the South African inflation rate. And what we do is we chart that thick band in the middle, which is reflecting our view on where the fair value of the rand is over time. And you can see against that, the rand sort of trades all over the place, pretty much ignoring everything Anchor says. What we do note, though, is coming out of COVID, the rand got significantly weaker than our models were suggesting. And then over the last year, maybe 18 months, we've actually seen the rand come back from very weak towards fair value. And in fact, the rand, as we sit here today, even at 16 rand to a dollar, is still weak relative to where we think it should be. So what has driven this? And we need to look at both sides of the coin. On one side of the coin, you've got the events in the US, and we've seen quite a lot of dollar weakness over the last year. In fact, about 10% of the rand's movement accounts to or arises from dollar weakness. If we sit here today and we say, what's happening in the US, what do we think the outlook is? The honest truth is events in Washington, D.C. are likely to continue to surprise the market and, in fact, the globe as a whole. And as this takes place, it is eroding and sort of fracturing the confidence in the dollar. And we are seeing the dollar lose some of its shine. I think that trend is likely to continue, but it's going to continue at a far slower pace, as I'll outline in a few minutes. The other aspect of it is we need to look at what's happening on the ground in South Africa. And Peter was alluding to that, where he was talking about some green shoots of recovery, some improvements. Fundamentally, we think South Africa is in a better position than it was 2, 3, 4 years ago. And from that perspective, we think that the trend of gradual improvement in South Africa is going to continue. Both sides of the equation seem to imply to us that the rand is going to continue to strengthen. And very, very much, it's so difficult to say where you think the rand's going, because at the time we put the presentation together, the rand was at 16.50, and 16 felt a long, long way away. We got there this morning. Where's the rand realistically going? I think it's probably going to touch our fair value band, and that's at 15.75. We're not very far from that. And at that point in time, it becomes incrementally more difficult for the rand to strengthen. That being said, the tide at the moment, the trends continue to be in the favor of the rand. And for now, I think it would be very difficult to bet against the rand, albeit we are talking that the progress in the recovery is going to slow down, but it is going to continue to be positive. So I think this year it's very likely we're going to see a 15.75 at some point. Beyond that, I think it starts to become increasingly difficult for the rand to keep strengthening. But let's look at the detail. Let's talk about what's happening in South Africa. And we're going to talk about the domestic environment. And I'm starting here with a chart which shows you the external balance of South Africa. So what does that really mean? It means this is the amount of US dollars and foreign currency reserves that the government has in its bank accounts. And you can see through the Zoom years, the sort of 2013 through to almost COVID, the government was very predictable. It maintained a foreign currency reserve of about $50 billion. Of late, those foreign currency reserves have increased quite meaningfully, almost doubling up towards $75 billion. Significant increase in foreign currency reserves. Now, we'll talk about why in a minute, but the point I'm making is that South Africa's external balance sheet looks the strongest it's ever been. And that is a small step in the right direction for South Africa. If we look at the external balance, the trade balance of South Africa, and this is what Peter mentioned earlier, South Africa Inc. as a nation exports metals, primarily platinum and gold, and it imports oil. Oil prices have gone down, so our imports are cheaper, exports are more expensive. It means that we are actually earning more dollars as a nation right now. Good news is we're clearly not squandering it, as we saw in the last slide. But what it does do is it makes a whole trade balance, our whole sort of economic positioning within the globe, actually quite favorable for South Africa. And that again is a small step in the right direction for our country. Looking on the ground, though, what's happening with the various sort of state-owned enterprises? And what we have here is a chart that is put together by Eskom and the South African Reserve Bank. I'm just going to talk about the top line, and what that is the electricity availability factor. In other words, it's basically measuring the efficiency of our power plants. And you can see through to from 2018 through to probably about 2023, there's a clear negative trend. Our power plants were becoming less and less efficient, the load shedding years. But in 2023, something happens. It's almost like the efficiency of those plants starts to increase again. I think a combination of actual maintenance that had finally been caught up, and a combination coupled with people just operating the plants more effectively, knowing what they're doing, being properly managed, has meant that the electricity availability factor stopped going backwards and started improving again. Load shedding is something we don't discuss every day. I remember the days when you'd go home and sit and try and figure out on the table how bad it was going to be tonight. Those days seem to have passed for now. And looking at this chart, it's very clear that there's been an improvement in our electricity supply, a small step in the right direction. If we talk about rail volumes, a lot is spoken about Transnet and the failings of Transnet. And it's very clear if you look at the sort of tons of goods sort of rail freight, you can see how that was declining quite drastically through to about 2023. Again, in 2023, you've got a situation where maintenance and actual focus on dealing with the problem meant that we've stopped going backwards. And if anything, there's a slight improvement that's taken place since then. Very slight, but we're moving in the right direction. The trend line is positive. It's no longer negative. Small step in the right direction. If we look at ports, our ports, you can see container volumes. This is effectively showing you the number of containers that go through the ports. And there was, again, a massive sort of drop-off in ports. And that was addressed a little bit earlier. We sort of stopped going backwards. And since then, we've seen infrastructure investment, we've seen private participation, and it's very reasonable to expect that that sort of positive trend, if anything, is going to accelerate. Again, a small step in the right direction. So all of these things I'm talking about are just identifying for you, key metrics of things that are actually happening on the ground in South Africa. And the point I want to make is these aren't theoretical things. This isn't like Ramaphoria, where there was a bit of positive sentiment, but it never manifested into any positive changes. What we're looking at here is actual physical things that really have occurred. Real goods on railway cars, real goods going through our ports, real electricity coming through the wires. And it ultimately is beginning to manifest in terms of the job market. So what we've got on this chart here is the number of people actually employed in South Africa. And you can see leading up to COVID, employment had by and large stagnated. South Africa had 16 million people who were employed, and it was wobbling around a bit, but going nowhere. It was a very sort of plateaued chart at that point in time. Through COVID, we unfortunately lost a lot of jobs. But since about 2022, we've been on a recovery trend. And there's a definite uptick and positive trend as to people finding new jobs. And that trend looks like it's continuing. Very importantly, if you look on the far right-hand side, you will actually see we've got over 17 million people employed now, compared to the 16 million before COVID. So compared to that previous plateau, we've got an extra million people who are earning a living, an extra million people who've got money in their pocket to go and spend at shops, an extra million people who've broadened our tax base. All of this, again, adds up to a slightly stronger South Africa, another step in the right direction. If we look at this, what this really means for the government, much has been spoken by myself and by many commentators about the government's debt levels. And what I'm going to talk about is the red line on the chart in front of you, which shows the primary balance of the South African government. So what is that? That is basically showing the income the government receives. So it's tax receipts is the main sort of source of revenue for the government, minus what it spends. So in other words, the money it pays to the policemen, to schools, etc. And you can see how the government's primary balance was negative through almost the last decade, or certainly the last decade or two. And then suddenly, in the last few years, for the first time, this primary balance has turned positive. That means the government is receiving more in tax receipts than it is actually paying out as expenses in various avenues. That is enabling the government to actually bring our debt under control. And it's looking more and more like that debt level that people were talking about and the debt levels people were stressing about is actually going to come under control. And it's becoming believable for the first time that the national debt levels will go down. And this is a large part of why we saw our first rating upgrades late last year. And we think that there's possibly further for this trend to run. Again, a positive development for South Africa. So as I sit here, I've seen a lot of little positive steps. And if we add them all together, there have actually been some pretty giant strides that we need to think about in the South African context. Now, in terms of where we're at, make no mistake, there are challenges in South Africa. There are going to be significant challenges for a while. But it feels as if the first green shoots of recovery are definitely showing. And if we continue down this trend, there's actually quite a bit of potential positive outcome in South Africa. That being said, how are foreign investors viewing this? So what we've got here is a chart on the left-hand side showing foreign ownership of bonds. And you can see how foreigners sold our bonds and then never came back. And on the right-hand side, you can see foreign ownership of equity, and foreigners sold our equities and maybe have sort of dipped their toes back, but certainly haven't come back. And from that perspective, we think that as foreigners start to see more and more credible evidence that South Africa is starting to put its house in order, that there's a definite upside to financial assets in South Africa, significantly more than we have seen of late. So bringing that together, what do we think for South Africa? We think that the positive momentum for South African financial assets is going to continue. We think that the market is baking in 2 interest rate cuts into its pricing. I think we may get an interest rate cut later this week, more likely in March, another one probably about June. But I think the market is underestimating the opportunity, and there may well be further rate cuts. So what are we saying from an investment perspective? Now is still a good time to lock in, earn interest income. We like the flexible income fund because it's positioned well to benefit from the upliftment of South African financial assets and earn a very attractive interest income. Looking globally, as Peter was saying, there's a lot of erratic and surprising events coming out of Washington. When you are threatening the governor of your central bank with prison, and people are seeing it as leverage to get an interest rate cut out of your central bank, that's bad for the credibility of your currency. When you are, depending on your view, kidnapping or arresting the president of a foreign country while he sleeps in his own country in his bed at night, that's bad for your credibility. And all of these events are just rattling the markets and rattling the confidence in the dollar. So that's creating the sort of concern that we're seeing. But if I look at this montage that our marketing team has put together for us here, there are a lot of positive aspects about the US that are counterbalancing this, and we need to be aware of it. So on the right-hand side, you've got President Trump holding his one big, beautiful bill that we spoke about last year. The point is that bill is going to add 0.5% to economic growth in the US this year. Top left, you've got the sort of brain on the computer chip, and that represents the AI capex spend. Now that's well known. The companies already forecast their capex spends, and it continues to be a race to invest the most heavily in AI and AI development because it seems to be the wave of the future. From that perspective, that is added 1% to economic growth in the US last year, likely to continue. Bottom left, you've got the United States Federal Reserve seal, and that represents the US that's cut interest rates by 1.75% since the top. Now, you cut interest rates today, and there's a delayed reaction before your economy starts to accelerate. But we should start to see some of that acceleration, again, adding to economic growth in the US. And then finally, you've got that robot there, which represents the AI productivity boom. And what people are doing is becoming more productive, and they're able to produce things faster and cheaper using AI. And that of itself is likely to see further support further economic growth in the US. So adding all of this together, yes, absolutely, there's a lot of surprises coming out of the States. But economically, one might argue that there's a lot of upside to the US as well, and investors are going to want to participate in that. And that's creating a bit of a counterbalance to the US uncertainty. So from our perspective, I do think that the US dollar does weaken a few more percent, but not like we saw last year. And that's why we think that the rand is only going to strengthen a little bit. But from a global fixed income perspective, US inflation is likely to come down faster than the market expects. We're likely to see interest rate cuts, and I think the pressure from the White House, coupled with lower inflation, means we might see more interest rate cuts than people realize. And that means bonds are actually quite attractive offshore as well, maybe not as attractive as equities. And we think that the best place to earn bond income is in the global high yield fund, because you've got, again, the good mix of a little bit of potential capital gain, but you've also got a stability of interest income. So with that, I am going to stop sharing, and I am going to hand over to Liam to talk you through our views on domestic equity. Thank you very much.
Thank you, Nolan. And yes, I think for me, I'm going to go back to domestic assets now after Nolan obviously spoke about them and spoke about offshore bonds. But I think Nolan painted the right sort of backdrop in terms of what we experienced or have experienced over the last 18 months, I would say, give or take, for South African equity. So why I use 18 months? 18 months ago is when we had our general elections in South Africa, and it certainly marked a sort of turning point, I would imagine, for one, sentiment in South Africa, but two, starting to get the green shoots of structural reform coming through. And I know, a lot of skeptics out there when the elections did happen, and we started off last year quite nervy with not being able to pass a budget, and I suppose the durability of the government of national unity or coalition politics being tested back then. But last year, well, I mean, we all know the outcome. The outcome is that it survived. But last year wasn't about local politics for once, which was quite nice. Last year on the JSE, an absolute standout year. So when you look at a sort of global benchmark for measuring a in-country's stock market, the MSCI has standardized this in their sort of methodology of constructing indices. So if you want to compare South Africa to other markets or any markets to another market around the world, choose MSCI because it's a pretty standard way of constructing the indices. South Africa, as measured by MSCI, which is in dollars, was up about 74% last year, give or take. Based on our numbers, that's about as good as we've ever had. I think the beginning of this index was in 1994, and we haven't found a year that's better than 74%. So close to, well, certainly on our numbers, the best year that we've seen for MSCI South Africa. I think if you go back, the 100 years of the history of the JSE, you might have found potentially better returns in rands. But nonetheless, it was just an unbelievable year. But what really drove it? So, well, in 2024, you had certainly a big shift in the local politics after years of people being very scared about investing in South Africa, and a complete sort of destruction of confidence from an investor point of view. Middle of last year, there's something that sparked a bit more interest in South Africa, and what you had was quite a broad rally across the JSE. The market was only up, I think, about, if I'm not mistaken, 2024, about 13 or 14%, but it was a very broad-based rally. You had contributions coming from all over the market as people's growth expectations started getting raised. Just a little bit more, sentiment uplift, raising multiples across the market. There was certainly a bit of a shift there. It almost went to sleep probably in the first quarter of last year, as the attention completely shifted towards what is now, we can look back on, certainly over the last 12 months to now, as an absolute, geluk for the South African economy, in that our big exports, being gold, PGMs, a couple of the other sort of more niche metals, are in a huge bull market globally. So after a couple of years of being in a bear market, there's been a couple of structural changes, certainly that's happened in the PGM side of things in South Africa, that's resulted in certainly a lot more scrutiny on whether or not there's enough platinum going around in the world to secure supply to satisfy demand over the next 5 to 10 years. These dynamics have been there for a while. I think there's maybe more of a appreciation for just what the longer term supply and demand dynamics look like. So that is, South Africa, as Nolan has mentioned, huge export commodity for us. That then starts to take center stage in South Africa. And from first, from around about the time that you had this sort of the tariff tantrum, if you want to call it that, when Donald Trump came out and started using tariffs as a negotiating tactic, which was around about the end of the first quarter, you certainly have seen a lowered dollar weakness, and that's spurred on big strength in gold and big strength and sort of bull market in the PGMs. And I think from South African asset managers' perspective, they were probably a bit underweight going into that after having absorbed a lot of domestic equities, domestically focused equities, which only account for about half the local market. During 2024, there's been a big rotation, I'd say, over the last 12 months to neutralize underweight positions that fund managers have had in golds and potentially, certainly the PGM stuff across the market. And we'll show you in the coming slides just how concentrated the index has become as a result of this. These companies are highly leveraged, so a 10% move in the PGM basket in dollars or in rands terms, probably could result in about a 2 to 3 times gearing to that from an operating profit point of view. So highly leveraged companies that were pretty much on the margin when the cycle turned in their favor. But at the same time, this was going on in South Africa, you almost had another positive confluence. So, as fund managers, when we're constructing portfolios in South Africa, you're kind of always dodging one part of the market because things seem to never really fully align. I would say over the last sort of year or so, things have aligned quite well in South Africa. It's almost like the pendulum started swinging together and not against each other. And you've had a big compression in the South African risk-free rate as measured by the bonds Nolan's been talking about. So you had about a 200 basis point compression from 10 down to 8 on our risk-free rate. In the pricing of equities, certainly local equities, local financials, when people build their DCF models, that can have an outsized effect on what the fair value of these companies are. Probably the most important marker that we look at as a research team is your starting point is what is your risk-free rate in the country. Big rally in our bonds last year. Again, a standout year for our bonds, over 25%, I think it was total return for our domestic risk-free assets. The second order impact of that was it filters down to many different parts of the market. And while the banks didn't look nearly as exciting as PGM and gold stocks, which are up 2 to 3 times, you certainly had a very healthy rally and repricing across our local financials. And they also came certainly in the last quarter. And I think that's what we were talking about in the last Where Will the Money Be Made webinar, was the shift that we think that now investors now needed to make back into South African banks and financials. We think that trend actually remains intact into the next part of this year. So yeah, both internal factors being structural reforms, repricing of South African assets. I think it was there was just windfall after windfall coming off the grey list, huge tax receipts that we weren't forecasting in the beginning of the year. All of a sudden local politics simmered down towards the back end of this year. One of the risks that we're seeing towards the back end of 2026 is obviously who's going to take over the ANC and how that sort of plays a role in terms of local politics and leadership as we head out into municipal elections. We are constructive on South African equities. We've got a 12-month total return of I think 12%. Where we are probably a bit nervous in terms of giving explicit forecasts right now is just how big that gold and platinum sector has become. It's over a quarter of the market. And again, we'll have another slide that shows that later on, which makes our forecasting risk, a little bit trickier because of just how difficult it is to forecast what those commodity baskets are going to do. So, again, just to reiterate the point, emerging markets had a good year last year, one of the first years in a very long time when emerging markets outperformed global equities. Certainly that de-dollarization and shift into international equities has the trend has been going on for the best part of 9 months now. Big flows into emerging markets. South Africa has caught that as a tailwind, and then obviously the internal factors that's kind of probably just pronounced that trend a little bit more. But this chart just shows you what a standout year it really was for us as South African investors last year. And in terms of the concentration of performance, so this is worth highlighting. So while the market, and I mean the JSE call it shareholder weighted all share index, which is the new index that we're all using, it was up about 42% last year, which is again, even in rands terms, on our local markets, just a standout year. Highly, highly, highly concentrated. So this chart just kind of shows you a list of all those shares in the index. And then the sort of left-hand side of that chart is the contribution from return just for a handful of those shares that made up sort of three-quarters of that return. So I think we calculated the top 15 shares was about 90% of that 42%. Very concentrated in golds, platinums. But it also should be mentioned that, if we strip out gold and plats and the Naspers, which is, a big part of the index, but we've got very little to do with the sort of ongoings on the ground in South Africa. You had about a 9% total return for South African equities, which is kind of thereabouts after a very standout year in 2024. At 9% is a pretty respectable return. I think for that part of the market, we had forecasted about 10% as we came into the year. I suppose also what maybe detracted a bit from that performance was that repositioning of local funds, which resulted in, a large part of our market just not getting enough sort of attention. Now, that part of the market is where we're sort of sniffing around for relative opportunities now. We think, after a great year from our perspective in 2024, finding those under-researched mid-caps, those interesting opportunities, we think that this year, with the growth that's coming through, with all the progress that's been made, you almost like being able to buy those companies again at really low multiples. But now all of a sudden, 18 months later, some of the data is going to support the growth that you're going to see out of these companies. And I think that people would just have more confidence in forecasting where earnings go from now, as opposed to repositioning for a bit of a hope investment thesis. In terms of, again, constructing our outlook for the JSE, we're sitting with about 12% total return. But again, just to highlight, for most of the last sort of 10 to 15 years, gold, platinums, highly cyclical. They can go, gold was in 2022, it was only about 2.5% of the local index, but it does fluctuate quite a bit just with the volatility on the shares and almost the crowding out of other sectors on the JSE as growth was scarce. This highlights just how much the index has changed over the last certainly 12 to 18 months. So I think they make up about 27% of the local market now. Gold at about 17%, and that's coming from about 2% back in 2022. Platinum's over 10% of the local market. So a significant amount of risk has been added to the JSE, not just from a forecasting perspective, from a volatility perspective as well. And one needs to just take that into account. I'm sure most asset managers are kind of thinking about that the same way, to say, exceptional returns from the JSE, but also a lot of extra additional risk being added in to the market. Let's look around for sort of more risk measured or more appropriate places to put capital on the JSE at the moment. So just to summarize, we're pretty constructive on domestic fundamentals, so that the conditions are improving in South Africa. An amazing way to play that is obviously through equities. We can tell there's still a lot of the companies, it's in certain pockets there are strength. There are certain companies that are strategically executing far better than others in South Africa. I think a lot of attention at the moment on the South African consumer, and when you're going to start to see earnings growth coming through from a big part of our local market that is consumer facing, which hasn't necessarily delivered the best returns over the last few years. I think that there are some structural shifts happening with the consumer in South Africa. If you look at the rise of spend on online gaming and gambling, that part of the market has taken a lot of discretionary spend out of the traditional sectors that you're used to seeing the money flow to. But again, supporting our thesis, usually there's about a 12 to 18, possibly 24-month lag from the start of a real commodity bull market to filtering down into the South African consumer. So we are expecting to see the benefits of that coming into play probably in the second half of this year. Couple of stock picks. I'm not going to take too long. This is all in the mid-cap space. We did one of our top 5 stock picks was also Valterra Platinum, which we're not going to discuss because it's not necessarily tying into this mid-cap theme, although we're very positive on the prospects of Valterra. These ones sort of have a golden thread tying them together. all in the sort of mid-cap space. There's a good chance that we've done enough research to suggest that there's going to be positive surprises this year. We don't think that the exciting prospects of these businesses are necessarily found in the share prices. They're probably a bit under-researched right now. With a lot of the attention from asset management teams being placed on the commodity cycle. And we think that there's interesting dynamics. So you got Kaap Agri, which is a sort of an agri retailer that is probably across the country more dominant in agricultural areas. They're transitioning into a fuel station business with convenience stores attached to them. Big growth ahead for Kaap Agri. We're pretty excited about that prospect. Blue Label in its new life without Cell C in it. So Cell C is now deconsolidated and you're able to value Blue Label without the Cell C business, as Cell C is now a separately standalone listed entity. We believe that there's about R1 of earnings at the center of Blue Label, and you're going to start to see very clean numbers out of that business going forward. Appreciate there's still a lot of skeptics out there on Blue, but we think that that presents an opportunity based on the work we've done. A company that people might not be familiar with is Optasia. It's a fintech, a Pan-African fintech play, big in using AI for the credit origination process. Again, you're paying, I think, about 17 times earnings on this business, and you've got 2 to 3 years of 25 to 30% revenue growth coming out of the business and very strong profit growth. And it's a highly profitable, highly cash generative business. We think at 17 times earnings, it's far too cheap, and it's one of our key picks for the year. Premier, interesting investment case. One of the only companies we've looked at over the last sort of whole cycle across South Africa that's put proper capex into the ground relative to market cap. So it's about 7.5 billion of organic capex and about 2.5 billion of acquisitions. And we think that this year is the year where certainly the organic capex is going to play a huge role in increasing margins across the business, where the Ayrton Bakery comes online for the first time. And we think that Premier is just a good example of a business that's invested through the cycle. It was under private equity, and now it's separately standalone listed entity with pretty strong prospects as the capex starts to generate some reasonable returns. Yeah, and that finishes me up. So again, 2025, incredible year for South African equities. We think that certain of these trends will remain intact. And yeah, certainly the large components of the index have got really good positive earnings momentum behind them, and no reason to fight that for now. And with that, I'm going to hand over to Mike Gresty.
Thanks very much, Liam. If you'll just bear with me a second while I get my slides up. Good afternoon, everybody. So as we change gears now, I'm just going to spend the next couple of minutes taking you through our latest views on global equities. Where we stand today, we're coming off 3 years of very strong returns from global equities. At no stage has that been an easy call. If you've traveled that road with us, I think you'll concur that we have scaled a wall of worry. And that's what I've entitled the presentation for today. I think that is really what is going to continue. Key message, as Pete mentioned in the introductory section, that I want to leave you with is the importance of maintaining a degree of balance around the risks and opportunities that exist out there. I think we're genetically wired to focus much more on the negatives. It's just the way humans are made, and there's no doubt that the doomsdayers seem to have a lot more gravity in the way they present their picture. But had you succumbed to that more negative thinking, you would have certainly missed out on several years of very strong returns. So just where are we positioned in terms of our thinking around global equities? It's a modest return expectation. I think it acknowledges that things are quite finely poised. Ultimately, we think when we get to the end of this coming year, what is going to prevail is the very strong earnings growth that's in prospect. We do think that it is potentially going to be a bit of a bumpy ride along the way, much as 2025 was. But at the end of the day, earnings growth prevails. And if you look at the prospective returns from equities, from global assets, it's certainly, as much as it's perhaps a little more modest than the returns we've seen in the last few years, it's still a very respectable real return we see. And we strongly urge investors to keep their eyes on the horizon. Turning to this issue of the wall of worry, keeping that degree of balance First of all, I'm sure none of these bear factors that have been widely discussed in the press in recent months are going to come as a surprise to you. There's no denying that equity valuations are high versus history. And while valuations alone have been a very poor predictor of short-term returns, the truth is that over the longer term, it's very hard to argue against the point that investing when markets are cheap is ultimately in your favor. But to call the end of this bull market at this stage, we certainly think is premature. There's been a lot of talk about whether 2026 will be the year that finally investor willingness to see companies investing heavily in AI without the requisite return on that investment will continue. And obviously, that's become a very dominant theme that's been driving investment markets in recent times. The last few weeks have revealed just how much of a wild card global geopolitics remains. We look like we may be heading in the very short term for another US government shutdown. And then just finally on those negatives, there's certainly been a strong view that had we not seen the AI investment, which has been so strong, that in fact the US economy could have gone into recession. And that obviously paints quite a worrying picture until you start considering what could go right. So it certainly looks very likely we're going to see rate cuts continue. Don't fight the Fed. I'm going to talk a little bit just now to the very strong earnings growth that's coming through. And ultimately, where earnings go, so do markets. Midterm elections, certainly that sets a whole lot of interesting incentives for the current Trump government in terms of securing their position in the second half of his term. Certainly, if one gives consideration to that, a strong economy with a stable currency and general stability, I would say, is what he would be looking to deliver. So it certainly feels like, maybe it's a little hard to say it after the last week or so, but we possibly passed peak Trump disruption. And certainly, I think we're getting to a point now where, people are, certainly markets are learning to interpret his moves and respond to them with a lot more balance. And finally, it certainly looks like a year of strong growth ahead of us. I think Pete put up a slide on that. So just getting into a couple of those things. What I'm showing here is the forward PE for the MSCI World. Keep in mind that that is about 75% made up of US equities. So as much as we call it the World Index, it is beneath the bonnet, very dominated by the big US companies and technology companies in particular. So we are in expensive territory relative to history. But I heard a saying recently that certainly resonated with me, saying, today is not your granddad's market. The makeup of the dominant companies that really constitute the bulk of this index is very different to what it was 20, 30 years ago. Margins are higher, returns on capital are better, they are less cyclical, balance sheets are stronger. And I think that's something you need to consider when you are assessing whether genuinely markets are really as expensive as they appear relative to history. Again, thinking back to where people might have been spooked out of markets in years gone past. Had you bailed out of markets in the early 2020s, where, if anything, valuations, as you can see them there, were a little bit higher, you would have foregone returns, compound returns of about 15% per annum in the intervening years. So, just keep that in mind and you need to consider it in context of, strong earnings growth to come, very healthy company setups, and strong economic growth. So we're really going to need to talk about possible events that could come at us out of left field to upset that apple cart. If you look at that earnings growth picture, Pete put this up earlier on. So, I'm not going to repeat what he said. I think the key point I'd like to point out, though, is that aside from what appears to be the case, that we're going to see stronger earnings growth out of a broad array of markets, and you can see the various indices there on the left-hand side. Not in the past, you might have criticized the market from a perspective of earnings growth having been very concentrated, particularly in the technology space. What is quite exciting is the degree to which this growth is now broadening out. And that really gives us the prospect of market performance, which is not nearly so concentrated as it has been in the recent past in that technology space. And that's, for people that pick stocks, I think a very exciting setup, which, gives you the opportunity to look beyond that very narrow group of companies that have driven a lot of the performance in recent times. In this chart, what I've done is face that ever-present concern that equity investors have about what about a major market correction. And there's no denying it. I think Pete mentioned it earlier on. There are any number of risks that could cause us to experience a major correction during the course of the coming year. But I think it's important to acknowledge, as much as followers of the 24-hour news cycle could no doubt list a large number of risks that could upset the market. If you look back at the bigger drawdowns we've seen, and I've gone back about 20 years and looked at cases where the market has drawn down or fallen by at least 15%. The numbers in brackets there give you the top to bottom move in markets, and the sort of size of that shaded area gives you a sense of how long it took from the peak for markets to reach that bottom. And if you just cast your eyes across, what were the major causes of those drawdowns, in virtually every single instance, it was something that no market soothsayer was really predicting ahead of time. In fact, if you look at the global financial crisis, they would have made movies, or they did make movies about people, that small exalted group of people that did foresee the global financial crisis coming. So, again, maybe you're going to find yourself in that space going forward. And rest assured, there will be times when we see a major crack in the market, and it will be uncomfortable. But the other point to note from this chart is that keeping your eyes on the horizon, taking advantage of those drawdowns to selectively add to positions, really does enable you to benefit from the broader trend, which is upwards and to the right. So as I say, as much as there are many risks out there, our advice is to prudently keep invested. Now, as Liam did earlier on, I'm just going to talk to a couple of interesting stock picks as I get towards the conclusion of our offshore presentation. These were the names that we highlighted as looking interesting within our universe shortly before Christmas. I wasn't sure whether putting their logos up would necessarily be as easy to identify as it is for the South African market, but essentially we've got Meta, well understood, London Stock Exchange, Booking Holdings, which is the booking site, Constellation Software, probably a not so well understood company, but it's one that we've favored over many years. It's a sort of consolidator of software companies globally. So these are often the underlying software businesses are not necessarily that well known by the general public, but they tend to be very focused on mission critical software within hospitals or power stations and that kind of thing. And finally, our emerging market pick is New Holdings, which in shorthand we tend to refer to as the Capitec of Latin America, but possibly at a much earlier stage. Now, when we pick these stocks, what we do with our team is we don't try to overlay any particular agenda or thesis. We really allow the best ideas as we see them at the time to percolate up to the surface. But it's quite an interesting exercise after the fact to say, well, what is the common thread that runs through these businesses that means that they look particularly interesting to us? They generally come from a pool of well-run, high return on capital businesses, good balance sheets. But what is it about them today that makes them particularly interesting? In all cases, with the exception of New, I would say they are out of favor at the moment. And probably the biggest thing relates to the question mark that the market has about the impact of AI on these businesses. And generally, at the moment, the market has bet against them, suggesting for varying reasons that they are going to be real victims of AI. And we are, if I was to sum it up, pushing back on that argument to some degree. I think 2026 is going to be the reckoning as to how companies are using AI. And in many instances, we think that actually these companies are going to prove to A, have a much more resilient business model, and B, prove to be able to deploy AI in a much more constructive manner than is being perceived by the market. I will say as a word of caution, when one is talking turnarounds, and I'm not suggesting these are necessarily in extreme turnaround territory, it often requires a degree of patience. So, whether we're fortunate enough to have called the bottom in these stocks remains to be seen, but that is ultimately the sort of direction of travel we're looking for. So just in conclusion then, I think a lot of people are concerned and anxious about many of the risks we've seen and asking what should they be doing about that today. And I had a little bit of a think about that. And I just wanted to flag a few things. I certainly think after 3 years of strong performance, now is a good time when generally we're at, close to all-time highs in global equities to have a good look and an objective look at your portfolio, considering, whether it is really in good shape to weather a drawdown. Bear in mind that if one considers indices, many people are comfortably positioned in indices and feeling very comfortable with their performance that they've seen over the last few years. But bear in mind that those indices have become very concentrated. The technology theme that has been so dominant over the last few years has meant that the S&P 500, for example, is now highly exposed to the outcome of that particular area of the market, even within emerging markets. If one was to drill under the bonnet, you would find that microchip makers are in fact a very dominant component of that index. It's obviously a good investor discipline to let your winners run. Don't cut the roses to water the weeds, as they say. But there is a degree to which that can become quite dangerous, particularly if we start to see some of those winning themes begin to waver. So very good idea at this stage. Just have a look at how dominant some of the positions in your portfolio have become and whether it might be time to do a little bit of diversification. The other thing is very comfortable to have been all in on technology, European defense, for example. There have been a few, as I say, themes that have been running for quite some time. But just have a little bit of a think about some of those more unloved areas of the market. Healthcare, for example, that hasn't done very well in recent times, but represents a very dependable, steady growth part of the market, and avoid being sucked into over concentration in the beautiful parts of the market that have done so well and could turn out to bite you in times to come. A lot of people are asking about whether they should be moving away from the US. And I would just caution you that there's a danger that the mad rush to try to do that really does risk diversifying your portfolio. Bear in mind, US companies often much more globally diversified than is commonly appreciated. Looking across the S&P 500, certainly the bigger names, in many cases, more than 50% of those earnings are being generated outside of the US. Whereas, moving into Europe, emerging markets brings with it all sorts of unintended consequences in terms of exposure to small markets, lots of regulation, lots of uncertainty from a geopolitical perspective in emerging markets. So, don't underestimate the strength of US companies, irrespective of what you might think about the politics and the currency going forward. And then the other thing, after 3 years of a bull market, it becomes very easy to creep up that risk curve, investing in more and more speculative businesses, weak balance sheets, investing in names and ideas that are a little bit more at risk, revenue-less business, profitless businesses. Yeah, they've got their place, but just make sure that they haven't become too material in your portfolio. Don't fall in love with them. They can often hurt you really badly. Think of 2022, when many of those profitless tech companies dropped 90% plus. So, good time to just be thinking about some of those things. And that, in conclusion, is a really good segue into thinking about one of the biggest and most challenging things that we're debating as investors at the moment, which is how one thinks about the whole AI investment theme at the moment. And to take us through that thinking, I'm going to hand over to one of my colleagues, James Bennett, who's got some very interesting thoughts on that.
Great. Thank you very much, Mike. Okay, I'm just going to bring my slides up. Okay, good afternoon, everybody. I'm on the global equity team at Anchor. My name is James Bennett. So I wrote this piece for the Navigator. It's a very sort of high-level thought piece. And it's really just, as the title suggests, the power of I don't know, that sometimes even for a person or even people with experience, it does actually make sense sometimes, and it's okay and sometimes even better just to say, I don't know. I mean, obviously, the huge question at the moment is whether AI is a bubble. And, I was just listening to a lot of the interviews at Davos last week at the World Economic Forum with all the tech leaders, NVIDIA, Alphabet, Amazon, Microsoft, and every single one of them is being asked this question whether AI is a bubble or not. And we often think of questions like this as only having two possible answers, yes or no. But actually, there's a very third and powerful answer that one can sometimes give, which is just no matter how experienced you are, no matter how much you've looked at a situation, just to simply say, actually, there's more power in signal in just saying, I don't know. And I think there's some real benefits in the case of this AI debate at the moment of going down that route rather than trying to force a yes or no answer for reasons which I'll discuss so over the next few slides. Now, I remember being a student in the early 1990s when the Gulf War, that first Gulf War between the US and Iraq was about to break out. And the then Secretary General of the UN was a guy called Mr. Perez de Cuellar. And I remember he had just had a last ditch meeting with a high level Iraqi delegation trying to avert this potential war between Iraq and the US. And you knew that when this guy came out the meeting that he was probably better positioned than just about anybody else in the world other than the US president himself to know whether there was actually going to be war or not. And, everybody is expecting a yes or a no answer. And with all that knowledge, he just said, I don't know. And the way he answered it, he just said, if you believe in God, only God knows. If you don't believe in God, well, then nobody knows. And I think that always stuck with me more than if you just tried to force a yes or a no answer. Now, thinking of sort of my own journey as an analyst, I think we sort of go through the complete circle with this kind of, answering questions, yes or no. So I remember in the mid-90s when I started as a junior analyst, of course, you walked in on the first day and you didn't really know anything. So every time a client or a colleague asked you a question, you kept saying, I don't know, I don't know, I don't know. And of course, if you just carried on doing that for months and years, your career wouldn't last very long. So you started upskilling yourself, you really dug down into the numbers and pushed up your knowledge base. And then you sort of became an intermediate analyst where you kind of backed yourself to know everything. And even if you didn't know the answer to something, you sort of almost pretended like you did. And I think where you really do the full circles when you become an experienced analyst again, you almost go back to sometimes, not always, but sometimes saying, I don't know, especially to these questions that are very forward-looking, very, very uncertain, like we see with AI at the moment. And right now, I think that probably is actually the best answer to whether AI is a bubble or not. And then, of course, what is an expert after all? Now, I'm sure this quote originally attributed to this American philosopher of about 100 years ago. We probably all know this quote in some shape or form, which says, what is an expert? Well, it's someone who knows more and more about less and less until he knows absolutely everything about nothing. And I think that's how I sometimes feel the more I look into AI, is that you just actually realize how little you know. For myself, over sort of the December holidays, I spent, while we were driving long journeys and that, spent many hours listening to a whole lot of AI podcasts and that. And I've said to a couple of colleagues when I got back that I think I actually know less about AI now than I did at the beginning of the holidays. The more you look into it, the more you realize how little you actually know. And that to me ties in perfectly with this term. Maybe many of you have heard of this concept of the so-called imposter syndrome, which was a term coined in the late 1970s. So here you have a guy in this case, you can clearly see he's an expert. He's traveling around the world. He's probably got a PhD in his topic, extremely knowledgeable, has written many, in academic papers on this. He's presenting, everybody hangs on his every word. They're all thinking, wow, this guy really, really knows what he's talking about. But then there's this sort of perverse thing that happens, that while this guy's talking, there's this little voice in his head which says, actually, you don't really know what you're talking about. You're just fooling these people. You're fooling every single person sitting in the audience here. And it really comes back to the fact that the more that somebody really knows about a topic, the more you actually realize how incredibly complex it is and how little it is that you really know. So, the research shows that about 70% of people will experience this at some point in their lives. And that actually, ironically, the more technical the field actually is that the person is an expert in, the more likely they are to experience this imposter syndrome. So then back to AI. Is AI a bubble? I'm sure you know what my answer is going to be. And that is that at this point, I actually don't know. I have to say, I'm not sure that anybody really knows at this point. But having said that, there's a few sort of high-level observations that I'm going to make over the next few slides. And I think there's one bubble that I probably have identified at the moment, and that's what I would call the AI bubble. And I'll say that again, the AI bubble. In other words, there's almost a bubble, it seems at the moment, in people calling AI a bubble. Every international business media that you go on and watch on TV, every second interview is interviewing some, expert saying that, he's absolutely certain that there's a bubble underway in AI at the moment. When you go onto your LinkedIn feed, many of the articles that you read, they are not necessarily people you link to, but it's, suggested feeds. And just every second article is just suggesting that we're in a bubble at the moment. So it definitely feels like there's a little bit of a bubble in that. The next observation I would make is that it seems to me that the AI bears are more confident they are correct than the AI bulls. The AI bulls seem to be sort of a smaller number of people. They seem a little bit less certain. They say why they think they're bullish, but the bears seem to be, very confident. It's just simply the AI bubble or, when the AI bubble bursts. And I suppose I'm not saying those people are necessarily wrong, but my question to them would be, how can you be so certain you're right? What if you're wrong? And the point I would just make here is that this is not usually how bubbles form. Bubbles usually form when the overwhelming consensus is just that everything is going to the moon and everything is, just going up in a straight line. Having said all of this, I actually think that this is good. I think this overwhelming skepticism that we see about AI and being a bubble actually makes a meaningful bubble less likely to occur. The CEOs of all of these big global tech companies are seeing the LinkedIn feeds, they're watching the business news, they're seeing all the headlines themselves. So if everybody is sounding the cautious note, it just makes it less likely to actually happen. And it's possible that the next bubble or the next blow up we see in the market could be more likely to come from something that absolutely nobody is talking about it at the moment. The next observation I would make is that many of these bearish arguments that one sees from the bears is kind of the same arguments just been rehashed over and over again. Now, it doesn't necessarily make these arguments wrong. We are as concerned about some of these arguments as probably be the next team, but you've almost got to the point where it's pointless even opening these articles anymore because you kind of know exactly what they're going to say. And of course, these two arguments, the first one is just the circular nature of these funding arrangements between NVIDIA, which is the absolute kingpin in this global AI trade, $4.5 trillion market cap, biggest market cap company in the world, effectively lending money to these underlying sort of purveyors of AI, in turn for which they either directly or indirectly buy NVIDIA's chips back into what they are doing. What themselves say, the CEO of NVIDIA himself says that, look, this is the biggest infrastructure build out the world has ever seen. And you are going to need a whole lot of funding to actually do this. At least the industry at the moment does seem to be able to do a lot of self-funding, either through lending or through their own cash flow generation, and that's not necessarily a sign that it's a bubble. And then, of course, the second argument that you see is just this huge explosion in capex from the hyperscalers, and that's basically the data centers. So that's Microsoft, Amazon, Alphabet, Meta, CoreWeave, Oracle, etc. And at face value, it is true that there's been an absolute explosion in the capex that these companies are spending, building out these data centers, and that's likely to go up exponentially again over the next couple of years. And of course, those capex numbers you see there on the right is the revenue of companies like Nvidia on the left. One of the AI interviews that I listened to over December was a US analyst, a guy called Gavin Baker, who's in financial markets, has been in tech investing for many years, and I was very impressed by, sort of the knowledge base that this guy had. But during his interview, one of the things he said is that in his view, there are probably only 500 to 1,000 people in the world who really know what's going on with AI at the moment, many of whom live in China. Now, remember that whenever you see something from, financial markets and fund managers and analysts, even like myself, most people in financial markets don't have a deep technical understanding of what's happening in AI. So we are very well aware of these, these funding risks and these capex risks. If we weren't concerned about these things, our AI exposure would probably be a lot higher, than it really is at the moment. But then we also balance that as well, that when you listen to people who really are at the coalface of what's happening in AI at the moment, you realize that there's something a lot more deep and profound going on than probably most, if not all, people in financial markets really realize. The other point that we would make about investing in AI as well is that you have to hold on to your views very, very loosely. And this is one of the advantages of just saying up front that I'm not sure whether AI is a bubble or not. It keeps you a lot more in the middle of the road. It stops you getting too overexposed to this theme, but it also stops you, running away from this theme. And, I've been in markets just over 30 years. And if you had to say to me now, what is the biggest narrative shift I've ever seen on a big company in my career? I would say it was the 2025 narrative shift around Alphabet, where the market was absolutely convinced that this company was going to get eaten by OpenAI. And by the end of the year, the story had changed completely. And the analogy I would draw here is you go and visit a friend, you're sitting on his porch in the afternoon, you see his black dog chasing his brown dog to the bottom of the garden. And in this case, this was OpenAI chasing Google, earlier last year. And you think, well, I'd hate to see what happens when the black dog gets hold of the brown dog at the bottom of the garden. You get distracted, you look away for a few seconds, you look back again, and what do you know? Here's the same brown dog, but now it's chasing the same black dog back up the hill again. And that was really Google with OpenAI last year. And it meant that at the end of the year, after a slow start to the year, Alphabet was hands down the best equity performer last year. And all the companies that are very exposed to OpenAI, like Oracle, and you could even say Microsoft to some extent as well, that had done so well earlier in the year, actually gave back a lot of those gains by the end of the year. So again, this is the advantage of, rather just acknowledging that there's so much going on here that we don't understand, is it helps you to not be too rigid on your views. And sometimes in AI, things are changing so quickly that you have to pivot very fast. One of the other things about all this AI bubble talk, now I was in the market in sort of from about 94, 95. So I went through that tech bubble boom. And one of the things I would say was very different from then to now is that the tech bears were more of a lone voice back then. They were mostly sort of more deep value fund managers. They were mostly ostracized for their views. They took a lot of pain with their investment performance by sitting out the tech boom. A lot of them had their sort of assets under management absolutely decimated during that period, and probably even a couple of them pretty much closed down during that time. Now, obviously, eventually, yes, they were right, and it was a horrible period, that sort of 2000 to 2002. But one of the anecdotal observations that I made during that time is that those people who got this sort of tech bubble correct in terms of saying there's a tech bubble, then sort of slapped themselves on the back and said, look, you see, we were right. These tech companies are all rubbish. This whole tech thing is never going to make any money. And they just turned and walked away. And to me, the real story of the last 25 years wasn't the people that for a couple of years saved themselves an incredible amount of pain. But the real heroes were the people that actually bought tech companies any point during that time, got a couple of the stocks right, and have had this 20 to 25-year generational run in these companies. Now, obviously, with hindsight, it's easy to identify, who these companies were. But even if you just got a couple of these companies right and held them for the long term, you've done phenomenally well. And that's what I worry again about, just getting too bearish on AI and getting too much in the bubble talk, is that undoubtedly at some point in the future, there's going to be a pullback, in some of these companies, as there always is. But if you're too negative, you're just going to miss probably what will be some amazing opportunities during that time. And remember that some of the AI companies that will end up being the winners in 10, 15, 20 years' time are probably companies that we sit here today we haven't even heard of at this point. And, anecdotally, there are a couple of examples of people who I would say got this right. So there's this guy, David Gardner, a co-founder of the Motley Fool advisory service in the US. He actually published his book late last year. He claims, and I think he's probably right, that second to Jeff Bezos, he probably has the second lowest break-even price on Amazon of any investor out there, where if you adjust back for all the stock splits that happened during that time, I mean, the stock's trading at somewhere around about $200 a share at the moment. His break-even price is 16 US cents a share. And he actually bought those shares not after the tech bubble burst, but actually before the tech bubble burst, and he held throughout. And ironically, his break even on Nvidia is also 16 US cents a share, stock adjusted as well. And he's never sold a share during that time. So almost at the end of my presentation, just wrapping it up. So how do you play the AI theme if you just say up front, look, I just don't know exactly what's going to happen here. And there's a quote here that I really love, which I think just kind of encapsulates it to me, which says, from the Swiss physician, many centuries ago, where he said, everything is a poison, what matters is the dose. So too much of anything will probably kill you. So in terms of the AI bull and bear theme, if you get too bullish on this theme, you're going to have theme creep in your portfolio. And when you look again, you're going to have 50, 60, 70% of your portfolio just exposed to sort of AI type of stocks. It's very dangerous. But if you get too bearish, and you just become the sort of the ultra AI bear, you can really miss out on some great companies. For example, the people that sold Alphabet a year ago, there are these great opportunities that you can miss out on. And as I said earlier, hold on to your views loosely. Things are changing incredibly fast in AI. And there's my final slide. So the next time your favorite anchor advisor asks you a really sort of deep, profound question about the future, and he or she looks at you and says, I don't know, they might be giving you a stronger signal there than you possibly even realize. If you really had to put my head on a block at this point and say, well, how do you see this whole AI thing sort of ending up? I think just because people are so aware of the risks, it's so well documented, that what I'm sort of hopeful is that it's more likely to be a series of mini bubbles in individual sort of AI exposed stocks or subsectors within the whole sort of AI in investing universe. And we're already seeing that with the market at the moment, where, a stock will suddenly, like Alphabet, turn around and do well. And then suddenly the market will go and prick the mini bubble in an Oracle, for example. But you don't see the effect of this at the broad index level. Thank you, everybody. That's my summary, and I'm going to head back to Pete Armitage just on this final slide.
Right, folks. Thank you very much. You guys will find that very interesting and intriguing from an investment perspective. James, if you want to just try and bring that up again.
Sorry, Pete.
So just to conclude, we've taken you through the investment markets, and we've concluded that domestic equities look pretty good. There's some nice returns to be had out of the SA market, and commodity markets we think have still got some room to go. Obviously, gold's going through an absolute blowout. The gold companies, the PGM companies, we think have still got a bit more legs. The non-commodity side of the market hasn't done that well, but the economy is coming through quite strongly. So we think that there might be a bit of a bounce in those as well. From a domestic fixed income point of view, bond yields have come down 250 basis points. The bond yield is now about 9%, but a lot of the macro things turning in South Africa's favor. And we think you could well get things go well, a double-digit return again from bond funds. Has been a great place to be for the last 2 years. We like our flexible income fund, which measures the risk and has a kind of a combination of core income and bond. From a global equity perspective, we're not calling the end to the bull market. Markets have got pretty expensive, so we think the probability is that the equity market returns won't be as strong as the earnings growth coming through, a little bit of a derating, and the risks are pretty high from a short-term perspective. But we think the market will end higher at the end of this year and the next. But certainly time to risk-proof your portfolios. We're not mad about global fixed income. We think a lot of they're kind of fairly priced where they are, and we're not seeing a higher return coming through from global fixed income than global equity. We like the Anchor Global High Yield Fund at a 4.75% return. I'm going to run through a few questions now. If I can ask the guys just to put their faces up again. There's quite a few questions that have come through on the Q&A. There's been over 1,500 people registered for this webinar, so we can't answer everybody, but maybe just to click through. First of all, are the slides available? Yep. If later on, we will send out certainly the documents to everybody and access to the slides. If you can't get hold of them, get hold of your Investec wealth manager. If you're an IFA, your contacts at Investec, and we're very happy to share the slide pack with you. There's obviously quite a lot of material there. There's another question regarding the returns that we show in funds. I think as a matter of course, when we show a fund return, that's from the fact sheet, and it's the fund return after all fees and costs that come through. So if a number is published in a CRS or a collective fund, that's certainly the industry standard. So some specific questions. Naspers process, Mike, if I can ship that over to you. A bit of a pullback. It's obviously been a great share over many, many years. It's a big thing in our market. We've got lots of it in our equity fund. How are you viewing that at the moment?
Yeah, thanks, Pete. So I think in part, I've been very frustrated by it and caught a little bit by surprise, I must admit. Partly it may relate a little bit to this giant sucking sound, which is precious metals. So, institutional fund managers may be liquidating a bit of their Naspers process position to reinvest in what's really working at the moment. There are a couple of, what would be the negatives out there? I think if one looks at Tencent, which is 80-odd% of the NAV, a few investors worrying about what they perceive, I should say, as a slight underinvestment in AI. I would question that, but that's one of the concerns. Naspers and Prosus at their last results signaled that they were going to moderate the pace of share buybacks, and that certainly was perhaps a more negatively received thing than I expected. So I have to say that at the moment, I think that the issues that investors potentially have with this grouping are, not nearly as severe as they're being perceived. I think it's a very good entry point. What I see is a business that discount to NAV is at a decent level within the band it's traded historically. I think Prosus is at about 37% discount to NAV. And you've got very strong earnings growth in prospect with Tencent growing double digits. And if Naspers Prosus deliver on their targets, it actually should grow faster than that. So within the context of a South African portfolio, it's a bit unloved at the moment, and I think actually a great entry point.
Okay, thank you very much. Maybe just obviously the Rand is top of mind, and a few people asking, kind of the sentiment coming through regarding, we cozying up with the terrorist countries. We've got Iran, lots of issues in South Africa. All of the negatives seems to have turned. And how do we view that in the context of the currency?
I think the context, Pete, is that political risk is very high in the globe right now. Political risk in Washington, because who knows what might happen next. And certainly that could spike the rand. And similarly, we are in an election year in South Africa, municipal elections towards the end of the year, and that tends to come with a sort of greater propensity for some crazy political maneuvering. So we've got to accept there are things that could really wobble the rand one way or the other, and the risk is a lot higher than normal. That being said, if you look at the conduct of South African politicians, they've by and large tried to sort of stay out of the fray. I know we abstained from the last vote on Iran, but the comments on Israel have sort of died down. I think the political positioning of South Africa, the politicians haven't been as vigorous as they have in the past. But yes, absolutely, old allegiances die hard. We know where the allegiances were. Many of them continue to be there, but it just feels like they're taking a sort of softer stance at that at the moment. So that's our base case with obviously significant forecast risk.
Cool. Again, maybe just sticking with that, the currency issue, the carry trade, where does that sit? Is that a thing?
Yeah, so I mean, what is the carry trade? It's to take dollars where you're borrowing money at 4% and invest it in South Africa, where Anchor's flexible income fund will give you 9%, and that gives you a 5% pickup. And if the rand is strengthening, you get currency gains added to that. So, you suddenly in dollar terms are looking at quite investing in South Africa becomes quite attractive. I had the charts up earlier, which says people aren't really doing that at the moment. It's been very small investors moving into South Africa. And I think, maybe event risk is something that's keeping guys cautious, but it does feel attractive. Part of the question I saw is, guys, how is Anchor taking advantage of this? I think it's firstly fair to say it's not a natural thing we really look to do every day. I think we're focused on getting the right stocks, the right bonds, and so on. But naturally, within some of our portfolios, we do take advantage of this, whether you parking your excess cash in the portfolios in rands instead of dollars. In some of our offshore funds, we've been doing that. I think the Worldwide Flexible Fund, for example, is a portfolio that's been very successful at that, and it's actually added a lot of value.
Cool. Nolan, maybe one more for you before we move on to James and Mark for a few more. The talk about scrapping the prime rate and the context of that and the outcome, I think it often gets misinterpreted in terms of the impact.
So that's probably one for James. I don't know. No, on the serious side, it's very clear that they are looking at the prime rate. It's very unclear as to what aspects of the prime rate they're looking at and what sort of amendments they're talking about. I think if we apply broad principles which say they're probably going to come out with something that favors consumers a little bit more, then it's likely good for borrowers. So what am I saying? I'm saying things like, at the moment, it doesn't actually make sense if you think about it, that all of the banks' prime rates are exactly 3.5% above government rates. And why is there no competition between the banks to have different prime rates and different lending rates? Curious question. Maybe there's some questions we can answer on that. The whole structure of who borrows at what type of rate and how it's communicated can be improved. So I think that we don't know what they're looking at. That's been purposefully opaque from the regulator, from the SARB, but the likely outcome is something that is more transparent for consumers, and that probably does benefit consumers. So I think overall it's a good time to ask the difficult questions, but I don't know where it's going to come out.
Yeah, no, and certainly from our perspective, I don't think it changes anything. Banks price with people, and it's prime minus or prime plus based on the risk. Certainly from my experience, banks are incredibly competitive against each other. There's 10, 20, 30 basis points on debt when you're out there as a corporate. The difference between the banks and based on your risk. And I don't think changing the prime rate or the label that's on it would change the price that we pay for debt. But I guess, let's have a look. James, talking about AI, and there's a big topic, and Michael Burry, the guy who called The Big Short, talking about depreciation of AI capex and how they're not depreciating it properly, and misrepresenting the returns that are gonna come through. Do you have a perspective on that?
Yeah, I got a couple of thoughts. I'll just say for myself, anecdotally, I've never found Michael Burry's calls to be of particularly good value, sort of day to day. I know he probably made a good call years ago, but feels like he's been riding off of the coattails of that for the last sort of 20 years. Well, the first thing is that at the end of the day, investors are not stupid. We've all got access to financial statements, and the cash flow says it all. If a company buys chips today and they spend, $80 billion or $50 billion on the data centers, that goes out of the cash flow right now. Whether they choose to write that off over, 2, 3, 4, 5, or 6 years, that's sort of an
I think
accounting.
the standard now seems to be that 5 years, huh?
Yeah. And the point is they were changing that depreciation schedule even before this AI boom actually started. And there's another interesting anecdote on this as well. So we all have this, idea that chips depreciate very fast and become worthless, and that furthermore, as these AI chips are developing faster and faster, that chips are depreciating faster. But actually, Jensen Huang, the CEO of NVIDIA, was quoted last week. He said, that actually some of the older chips from 2 to 4 years ago, the prices are going sideways to even up. They're in such demand. And I actually went and fact checked that, and he's right. So, the sort of idea that chips are becoming from 3 to 4 years ago worthless today, that's actually not true. And a lot of them are getting maybe repurposed for slightly less intensive tasks. And it's only really, the frontier models that really need the latest and greatest chips. So my conclusion on all of that is that those changing depreciation schedules is probably more of a storm in a teacup than anything else.
Thank you. Mark, let's move over into local equities. Interesting today, there's quite a few questions about the telco sector. Maybe just briefly to touch on the views on Blue Label, which Liam did do some of, Cell C, and how do we look at MTN in terms of how strong that share price has been with its Iran connection?
Yeah, so maybe just start with MTN quickly. First of all, the story in MTN, and it's had a very, very good 2025, has chiefly been about its non-South African businesses. So let's make that clear up front. And in particular, Nigeria. So we are certainly going through a period when the stars are aligning for its non-South African businesses. And that's really what's been driving very nice earnings upgrades. The currencies have been nice and strong. Economic growth has been decent. And for once, the regulator's not been getting in the way of any of that. On Iran, quickly, in truth, you haven't really been paying for that in the share price. So I think it's fundamentally correct that as uncomfortable as some of the news flow around Iran is at the moment, MTN wasn't relying on it for the cash flows, and investors have written that off long ago. So, it's possibly a nice one in the future. They've indicated they would like to sell it, but are being patient around when that might happen. But it's fairly insignificant, if I can call it that, in the investment case, other than if you start considering possible black swan events like US government action against companies that have exposure to Iran. So that's an ever-present, can I call it, black swan with a business like MTN that operates in some of these markets that are challenging to say the least. And then Blue Label.
Cool. Yep.
Sorry, quickly on Blue Label, was one of our picks.
Sorry, yeah.
Sorry, was one of our picks for the coming year. Obviously been a little bit of a controversial one, and we feel we are swimming against the tide of current sentiment on it. Very briefly, my summary on it is that they've done themselves no favors in terms of giving investors clear sight of what the non-Cell C part of the business looks like. We think that it probably generates around R1 of earnings that's very near cash and is growing nicely in the double digits. All that money has historically been disappearing into Cell C, so you haven't really seen it. Cell C listed at a much lower valuation than the bulls had expected. But at the moment, you're effectively getting Cell C I think, on a PE of about 5 and a bit. So it's the cheapest telco in the sector. Obviously, there's some debate around the model and whether it will work. I certainly think that in the next few years, it's going to surprise positively. And at the moment, you're getting a very cheap Cell C, and you are not paying anything for Blue Label. And I think in the next set of results, you're going to start to see a much cleaner picture of just what a strong business that is. So, a real misunderstood story that we think is going to be our wild card for the coming year, and we'll see if we're right.
Cool. And then maybe just to close off, I'll make a comment. There's a few questions on the property and the REIT sector in South Africa. I think it's been a very interesting one. You've seen a nice kick in share prices. The growth points around, gone up from the 12, 13 rand over the last year or two up to the kind of 17, 18 rand level. When you talk to the properties on the ground, things are still pretty tough out there. The cost base continues to increase. Rates and taxes are going up materially. And it's difficult to get the kind of rents that are required in order to get proper returns, certainly on new developments. I went to go look at some corporate properties the other day. The guys for new properties wanting 300 rand a square meter, where I can get kind of older space at around the 200 rand level. But vacancies are decreasing. I think in the industrial space, it's been pretty strong. Retail has recovered somewhat. And office has obviously been the big problem from a COVID perspective. But if you think we're sitting in 2025, so there's been 5 years of big rent reductions coming through. But most of those are kind of worked their way out of the system. So we think the average property company can grow their earnings at 4 or 5%, perhaps 6% of the next year from a domestic perspective. But the share price appreciation has come more from the macro conditions and the compression of bond yields than the performance of the property companies themselves. So, with bond yields coming down 250 basis points, which we spent a lot of time talking about in this presentation, and Nolan's explained the context of that. So the price of money has come down. The required return that people are looking for from a kind of a steady investment is lower. So that's increased the value of property companies and property shares. So the big ones are trading at forward dividend yields of around the 8% level. But if you've got that 5, 6, 7% growth plus an 8% yield, if the yields stay where they are, that's a 13, 14% return. Our projected return in aggregate is a little bit lower than that. But with inflation at 3%, that's pretty decent returns. So, if you've been a long-suffering shareholder sitting through with SA Property shares, we'd hang on to them. And, there'd be selected ones that we'd be happy to purchase. If you chat to your if you chat to your representatives at Anchor, we're very happy to share our property views with you. We've got a big, strong property team who gets views out there. From a global perspective, we moderately, the universe is so big in global property, we certainly wouldn't be buying indexes. There's some very interesting opportunities in the US. But yeah, I mean, we do capture some of that in our alternative funds. We do own some offshore property. Globally, we quite like owning private property as opposed to listed, because they can, good quality properties, and our investors, we have exposed some specific projects, good quality properties that, you should be gearing 50, 55% in global terms. It's just not suitable for listed markets. So they're subject to the vagaries of what happens to the price of money, and you can see the prices swing around, as opposed to just letting operators get on with the compounding effect of property. People have made lots of money from property over time, but structured in the right way with the right risk in the right region. But it's, very happy to chat to individuals about that. So guys, that's kind of the end of our time period. I hope it's been very useful to you. We've had a record audience today. Over 1,500 people registered for the webinar. A lot of interest in what's happening in global markets. So it's been a great time for the last year or two, unless you measure your offshore investments in rands, where that took 13% in rand terms off last year. But certainly foreign assets should be viewed and measured in the currency of the country where they sit. We think diversifying globally at this kind of currency makes sense. The good times never last forever, and a lot of the rand impact is cyclical. But for the time being, the trend is pretty strong. And in equity markets, for the time being, the trend is upwards. So we're not calling for major moves. We obviously look at things very closely. As Mike Gresti says, we've got to risk-proof the portfolios and analyze things pretty quickly. But I think it's a year where we're going to have to keep a very careful eye on what's going on. But for the time being, we think the good times will continue. So thank you very much, and good luck for 2026.